Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. Last week, I talked about capital gains taxes on investment income. This week, I thought I'd follow up to talk about how dividends are taxed. For tax purposes, there are two different kinds of dividends, qualified and non-qualified. Non-qualified dividends are sometimes called ordinary dividends. Similar to capital gains tax, the tax rate on qualified dividends is 0%, 15%, or 20%, depending on your taxable income and filing status. The tax rate on non-qualified dividends follows ordinary income tax rate brackets. In both cases, people in higher tax brackets pay a higher dividend tax rate. Since qualified dividends are taxed at a lower tax rate, you may be wondering, what are qualified dividends and what makes a dividend qualified? There are three things that determine whether or not a dividend is qualified. The first is that it's paid by a U.S. corporation or qualifying foreign entity. For many investors, this condition is easy to satisfy and just depends on where the dividend is coming from. The second criteria is that it actually is a dividend in the eyes of the IRS, not necessarily helpful for the definition. The third is that you have held the underlying security for long enough. The definition of enough gets a little tricky, but typically, if you own the security for more than 60 days during the 121-day period that began 60 days before the ex-dividend date, then the dividend is usually qualified. So what does that mean in actual plain English? The ex-dividend date is the day that you must have owned the stock to receive the dividend. When a company pays out a dividend, it does so to all the shareholders who own a share of the stock by a specific date. If you purchase your shares of the stock after that date, you won't receive the dividend. The dividend is typically paid out much later than the ex-dividend date, the date they're announcing the dividend payout, usually by at least a month, but maybe a few months. For example, let's say you own stock in company ABC. Company ABC declares a dividend payment on September 19th and sets a record date for a month earlier with an ex-dividend date of October 19th. In order to pay the lower qualifying dividend tax rate, you would have had to have held the stock for at least 61 days within the 121-day period that began 60 days before the ex-dividend date. So 60 days before October 19th is August 20th. The 121-day period would be between October 19th and December 18th. If you hold the stock for at least 61 days between October 19th and December 18th, then you would pay the qualified dividend tax rate. When you count the days, you include the day you sold the shares, but not the day you bought them. This applies to common stock. Preferred stock has different rules where investors must hold preferred stocks for more than 90 days during the 181-day period that starts 90 days before the ex-dividend date. So really the difference is 90 versus 60 days. With preferred stock, you just have to hold the stock longer. If you haven't held the shares of stock long enough, then the IRS might deem that the dividend is not qualified and you'll pay the higher non-qualified tax rate or your ordinary tax rate. Now, you may be thinking that you actually don't own any individual stocks, so this doesn't really matter. However, this applies to any stocks that you own within a mutual fund. Remember, when you buy a mutual fund, you own all the stocks that are in that mutual fund. The point is that you have diversification. By buying one share of a mutual fund, you now own hundreds, if not thousands, of different stocks. You just own a tiny fraction of all that. The holding period rules is slightly different from mutual funds, but the principle is really the same. Whether a dividend is qualified or not depends on when the mutual fund held the stock, which is different than when you actually held the shares of the mutual fund. When you hold a mutual fund, you don't have control when stocks are purchased or sold within the mutual fund. This is another reason why index fund investing wins out over active fund management. Remember, when I say mutual fund, that does include index funds. Index funds are a type of mutual fund. With index funds, the stock of the companies within the index are purchased and held without active trading. So with the S&P 500 index fund, there are 500 companies in the S&P or Standard & Poor index. And so an S&P 500 index fund just buys shares of all 500 of those companies. It doesn't buy and sell those shares on a regular basis because it's not actively trading. It buys more shares as more people buy shares of the mutual fund so that it's deploying the money that's coming in order to keep it all invested. This makes it much more likely that any dividends paid by stocks held within an index fund will be classified as qualified dividends. Mutual funds distribute dividends to their shareholders based on their holdings. This could happen once a year or multiple times a year. These dividends come from the interest paid on any bonds or dividends paid by stocks in the fund's portfolio. So it's not that when a stock held by mutual fund pays a dividend that gets distributed to the shareholders immediately, but it does get distributed to the shareholders eventually. But of course, rarely are things easy with the IRS, so there are always caveats. There are other considerations for foreign companies. There are some foreign companies where a dividend from that company would qualify as a qualified dividend. A foreign corporation qualifies for special tax treatment if the company is incorporated in the United States, or if the stock is readily traded on an established securities market in the United States, like the New York Stock Exchange or the NASDAQ, or if the corporation is eligible for benefits under the income tax treaty. Of course, there are some dividends that are just not considered as qualified dividends. And dividends paid by real estate investment trusts or REITs are never considered qualified. This is also true for dividends paid by tax-exempt companies or co-ops, as well as dividends paid through master limited partnerships. Special one-time dividends are also not considered qualified dividends. Dividends paid from money market accounts is considered interest income and not a dividend. So there's a difference between a dividend and interest in the eyes of the IRS. So this really applies to any deposits in savings banks, credit unions, or any other financial institution. In all these cases, it would be considered interest, which is taxed at the ordinary income rate, and not a qualified dividend that would be taxed at the capital gains rate. There are other exceptions that are all detailed in IRS publication 550. So why the lower tax rate for qualified dividends? The idea is to incentivize companies to share their profits with their shareholders and to also incentivize investors to hold stocks for a long time in order to earn those dividends. Again, the government is incentivizing long-term investing as opposed to short-term investing. Like with other investment income, there is an additional 3.8% net investment income tax, or NIIT, on qualified and unqualified dividends, which are both considered investment income. This tax applies to anyone with a modified adjusted gross income, or MAGI, M-A-G-I, that is above $200,000 for single filers, $250,000 for married filing jointly, and $125,000 for married filing separately. It does seem unfair to me that a single filer gets up to $200,000 and married filing jointly is $250,000 when in my mind it should be $400,000, right? Two people. And they even make it that if you file separately, that you only get half of the $250,000. But that's our government for us. The net investment income tax went into effect back in 2013. And it was actually implemented in order to raise revenue to fund the Affordable Care Act, believe it or not. The tax brackets for the dividend tax rate for 2024 is as follows. If you're single and you make less than $47,025, then you would pay 0% tax on any qualified dividends. If your income is between $47,026 to $518,900, then you fall in the 15% tax bracket for qualified dividends. And if your income is greater than $518,901, then you're in the 20% tax bracket for your qualified dividend income. If you're married filing jointly, then you're at the 0% if your income is less than $94,050. If your income falls in between $94,051 to $583,750, then you'll land in the 15% tax bracket. And if your household's making over $583,751, then you'll be in the 20% tax bracket. If you're married filing separately, you'll fall in the 0% tax bracket if your income is up to $47,025. If your income falls between $47,026 to $291,850, then you'll fall in the 15% tax bracket. And if your income is over $291,851, then you'll end up in the 20% tax bracket for your qualified dividend tax rate for 2024. In the end, you don't actually have to figure out if a dividend is qualified or not. When you get your tax forms from your trading platform or your broker, it will state what dividends you received along with the type of dividend. So you don't have to do anything to determine what dividends you received or what they're categorized as. You'll see the value for the qualified and ordinary dividends paid to you in separate boxes on IRS Form 1099-DIV. Ordinary dividends are reported in Box 1A, whereas qualified dividends are reported in Box 1B. The real takeaway from this episode is that qualified dividends are taxed at a lower rate than ordinary dividends. And in order to have more of your dividends be qualified, you want to hold on to any stocks for longer periods of time, especially if those stocks are ones that pay dividends, or investing in index funds that tend to hold stocks for a long time as opposed to trading in and out of stocks so that more of the dividend income is considered qualified instead of non-qualified, so you can pay less taxes on those dividends. I hope this episode helped you more with your financial literacy and also just an understanding of how taxes work and how the government taxes investment income. Thanks for being a listener of the Grow Your Wealthy Mindset podcast, and I'll be back next week with another episode. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.